Sugata Gupta, Chief Executive Officer, Consumer Business, Marico, joins us live now. Sugata, morning. Thank you for joining us. The board has approved a 4.6% stake sale to foreign investors, and the company is planning to raise 500 crore via this stake sale. What will you do with 500 crore what will you do with 500 crore?
It will be used to part finance our acquisition. So that's, and we had said earlier when we had done the Paras acquisition that we will meet it with a mixture of raising equity and internal accruals and debt. So that is to part finance our acquisition.
Sugata, hi, morning. So how much of this 500 crore rupees would be diverted towards the Paras acquisition?
So we're not in a position to share exact specifics because, as I said, that it will depend on at that point in time. So at this point in time, as I said, that we will use it for part financing that acquisition.
Give us a ballpark figure. Would it be 50%, 75%?
Right now, as I said, we are not in a position to discuss details on this.
Fair point, Sugata. So why equity dilution when you could have taken a low-cost foreign-denominated debt?
I think as I said, we looked at, we thought that we had to take a judicious mixture of all three. We have certain internal accruals, obviously, and we want to take some, we will obviously take some debt. But see, as I said, that it is not just, I mean, it's obviously we also have to have a certain war chest for the future. So it's better to have a mixture of all three rather than going in for one.
When you say you're planning to have a war chest for future, can I read in between lines? Is this indication that you are planning to acquire something big in the near future?
See, if you look at the, I mean, as I said, that acquisitions was obviously a clear function of strategic fit and opportunities. So therefore, we will continue to look at acquisition in emerging markets. So I think that is something which, as I said, there is always it depends on the opportunities and a strategic fit. So we are acquisitive. At the same time, it has to have the right valuation and the right strategic fit.
So Gata, but is this it, the sum total of 500 crore rupees, or would you require more funding as well as internal accruals to fund the Paras acquisition?
I think see, as I said, that we are not looking at just the Paras acquisition as one part of it, but we are looking at the entire Paras acquisition. When we had done the acquisition, we had decided to fund partly through raising of equity, partly through some debt and internal accruals. And obviously, when we decided to raise the money, that money will will not only fund the Paras acquisition, maybe that if there is something could be used for future also.
Could you tell us how much will Paras contribute to your top line and bottom line from FY13 onwards?
If you look at Paras around, it's when Paras last year numbers are around 150 crore plus. However, as you know that all these categories in which Paras personal care products are in are low penetration and are growing at growth rates anything between 25 to 40%, with deos growing at 40% in the last 3 years, and the male styling and the leave-on conditioners growing at around 25 to 30%. So it's expected to fast forward our growth. And obviously, these are personal care products which have relatively higher margin. And since we are just buying the brands and not much anything else, there is no marginal fixed overheads to that. So therefore, whatever is the net contribution from these businesses, there will be very little marginal fixed overheads hit. So therefore, net contribution flows in straight into the operating margin to a large extent.
Over the years, Sugato, Marico has sold some of the non-core brands. Are you looking at exiting your non-core brands completely?
See, if you really look at it, both Sweetquar and Sil, which we have divested in the last 4 years, the reason was it didn't have a strategic fit. As far as Sil was concerned, we had our entire aspiration was to be area and beauty and wellness. Sil didn't fit in there. Sweetquar was a brand which we believed that didn't have growth opportunities because it was stuck in the middle in terms of either margins or in terms of kind of a definite consumer proposition. Right now, we don't have any such brands in the stable. We have certain brands which we don't invest behind, but what happens in the emerging market always that there are certain categories which start reaching a point of inflection, and you then start investing behind them. So as of now, there's no such plans. We don't have any non-focused completely brands which are ripe for divestment.
You have some brands. You have some brands in the home care / starch market.
See, I think that category which we are talking about is Revive. Revive is a brand which, as I said, the practice, and we have moved that brand from a plain powder starch to a liquid starch. The category is expanding and the brand is doing pretty well.
You're not looking at selling Revive?
No.
It's 80 crore brand. What stops you from selling it?
See, I think the issue is you have to, as I said, that ultimately each brand has a strategic role to play. It's not that all brands you invest disproportionate A&P to grow the category. This is a habit which is only going to grow. And as I said, that as long as the brands have a strategic fit and it has a certain profitable, sustainable, profitable growth path, I think it's critical to be in the portfolio.
Saugata, are you also looking at mulling a price hike or undergoing any sort of price revision in the near future?
See, if you look at it, certain vegetable oil prices have shown, in terms of input cost pressures have been there for the last 3-4 months. In February, we had taken some price increases in Saffola. In addition to that, obviously, there has been some excise duty push, and there is a. So we are mulling, we are contemplating price hikes, yet to take any call, but so far in the last 2 months, we have taken some price hikes of around 7 to 8% on Saffola.
So which segment would the price hike be in? Would it be across the board?
In Saffola, weighted average, yes. A weighted average price hike of around 7 to 8% has been taken in the last 2 months.
Let me understand the vision of Marico. And it would be quite engaging for our viewers to get this number going from you. The number I want to understand from you is that a percentage of your total sales for Marico, how much is coming from the oil business? And after 5 years, how much of your total sales will come from the oil business?
See, ultimately, if you look at whatever we are doing in emerging markets, in our international business or the Kaya, or even in our India business, in terms of creating a portfolio of the future, obviously we want to reduce our dependence on the core. Having said that, it is extremely critical that our core will continue to grow. So what you can really look at, and we have obviously certain aspirations which we have taken. Say, we'll take a case of Saffola, and case of Saffola, we believe that currently only around 6 to 7% of the turnover comes from the food business. We believe that in the next 3 to 4 years, the food business should contribute to 25% of the Saffola turnover. And the case of the hair oil business, obviously we want to reduce our dependence to the extent of 5 to 7%. Having said that, we believe that this business, the core business, needs to continue to grow at double digits, and we are pretty confident of the fact that we need to grow in double digits in our core business, and therefore that generates cash for not only innovation in India, but also our growth in the international markets.
And final question, what about raw material pressures? Do you think you are fully hedged, and even if raw material prices, they appreciate in FY13, it will not impact your margins or your profitability?
If you really look at emerging markets, our entire philosophy about growth in emerging markets is that it's for the medium term. On the short term, it is far more important to retain a consumer and therefore focus on volume growth, because margins always come with scale. Margins can always be retained. As far as volatility is concerned and input cost pressure, it's here to stay. The question is, organizations who manage volatility better, I think will perform better in the long run. So if you really look at last year, for example, we had to take around 32% price increase in Parachute. Still, we had delivered in the first 3 quarters double digit, around 9 to 10% growth in Parachute rigids. So yes, input costs are here to, is going to remain volatile, but as far as we are concerned, one of the main input costs, which is due to copra is slightly softer than it was last year. Having said that, if you see the general firming up that is happening, it's very difficult to say. But as I said, we have to learn to manage volatility and manage costs as we scale up much better, and we are in the process of doing that.